if you say beta of a company or a mutual fund, right? Beta of a mutual fund is 1.0. Then that means whatever the market is going to do, we expect the mutual fund to do the exact same thing. If the beta on a mutual fund or a stock is 1.2, then we think it's going to be more risky than the mutual fund. So than the market. So wherever the market goes, the mutual fund is going to go whatever that is, and then a little bit more.
So it's a correlation to the market.
It's kind of like a correlation, except remember with correlation, you can only go from -1 to +1. With a beta, you can go from negative anything to positive anything. What you normally see for American stocks, especially large cap stocks, is betas between say 0.6 and 1.6. They're kind of in a range. And so a good reminder is General Motors. So General Motors and General Electric, large companies make up a significant part of the S&P 500, which is generally defined as the market. And so if they move in some way, the market's probably moving the same way, because they're such a huge player in the market. And a company that is so small or has almost no beta to the market, let's say Japanese real estate funds. The beta to the American stock market, maybe 0.2. No, it's really, really low. And in a perfect world, now look at this. Depending on your views of the market, let's say you think the market is going to do really well this year. Do you want a high beta or a low beta portfolio?
Low.
Highest you can get.
What?
Now, if the market's going to do really poorly, do you want a high beta or a low beta portfolio?
Low beta.
As low as you can possibly get, as negative as you can possibly get, to go the opposite of what the market does.
Wait. So wait, sorry, I had said low because I thought it was you trying to get to 1, you're just trying to get high?
You're trying to get below 0 if you can. Because you can have, remember with correlation, you can have a negative correlation. But remember, it's bounded. Correlation is always between -1 and 1. With betas, though, you can have -6. I mean, that would be really insane. It means whatever the market does, the stock or the mutual fund is way, way below that.
That would be like the bond. The bond would have a negative beta to the stock market.
Yeah, probably, yeah. But remember, don't just multiply it. Don't just say, if the market's up 10% and my stock is a beta of 1.2, then my stock is going to be up, 12%. You can't do that. Remember, you have to use CAPM. Expected return on the stock equals the risk-free rate plus the beta times the market premium. That should just come to you guys like it's nobody's business.
So Alex, in the slides where he shows all the betas for different companies, Google is an outlier with a beta of -0.07. Any ideas? What does that mean?
Google's nuts.
Because most companies have a beta of, as low as it was 0.4 and goes as high as 2.54.
Well, here's a great question. So remember when we were talking about, remember we talked about that toilet seat making factory? How much did we, remember we had $1 million in revenue per year? Remember the first price that we came up with for that?
8 point something.
8.33. I mean, I'm skipping some important stuff here, but just generally, how many times of a year's worth of revenue are you paying for this company? 8 times, right? You're paying 8.3x a year's annual profits, right? I mean, this is a rough back of the envelope calculation, but it gives you an idea. Now, if you see in the market lots of other toilet seat cover making companies, and they've recently been selling to private buyers, and the recent prices that they've been selling for are 9.7x, 10.3x, 14.2x. This is all over the world you're seeing this. They make the exact same type of product. They have the same type of market, same number of employees, different revenue numbers. But this is the multiples they're selling for. Are we getting a good price or a bad price?
Low.
We're getting a pretty good price because we're only paying 8.3x. A year's worth of revenues. So here's the thing with Google, and here's the thing with something like Amazon. When you look at Amazon, its price to earnings ratio, I don't know what it is, but it's something like 100 times. Which means the price for the company per its earnings is 100 times its earnings. Remember, you were paying 8. The market generally, the price to earnings ratio for the market is roughly 14 or 15 times? So 14 or 15x. So when it's really low, that means prices are really cheap. When it gets really high, like for an Amazon, which is at something like 100x, things get really out of whack. It's really expensive. So when Google IPO'd in 2004, I mean, it's getting kind of into the weeds, but they did a reverse Dutch auction IPO. And essentially they IPO'd at 84 bucks, except their growth was expected to be huge. So here's the thing. We paid 8.3x. We knew we were getting $1 million at 5% growth per year going forward into infinity, right? Maybe the people who got 14x, their expected growth rate on that company was going to be 9% per year going forward. And so they're willing to pay for it because they're going to higher growth rates. The thing with Google is nobody knows what the hell the growth rates are really going to be because it's something that 10 years ago nobody even understood. I remember there was no Facebook in 2000. In 2000 we had Yahoo and Ask Jeeves and Dogpile and all kinds of search engines. Nobody knew that a search engine would be one of the largest companies in the world. So nobody knew how to value it. And so its relation to the S&P 500, the market, is just completely out of whack. Whereas General Motors, however the economy does, is how General Motors does. So when the economy was going well into the late 90s and early 2000s, people were buying SUVs. General Motors did well because that's what they sold. When the economy went down in 2008 and people stopped buying SUVs, General Motors went into bankruptcy.
So their beta be 0 or is their beta?
Their beta is
plus
almost
0?
1.
One.
Yeah, because they go with the market.
Okay.
Whereas Google does whatever the hell it wants to do, and nobody really knows why.
Well,